Welcome, everyone. Today, we are breaking down a concept that completely changes how you view your daily grind. We're talking about the absolute fundamentals of wealth building here. The most critical shift you can ever make in your financial life is moving from working endlessly for your money to finally making your money work for you. It sounds like magic, I know, but actually, it's purely mechanical.
Seriously, have you ever looked at someone who became incredibly wealthy and just asked yourself, what do they know that the rest of us don't? We often trap ourselves into believing the answer is, a massive six-figure salary or inheriting a successful business, or just plain getting lucky. But if you actually study how millionaires and billionaires build their fortunes, the secret isn't just about the paycheck. It's about leveraging the incredible power of the stock market. So here is the core mantra you really need to adopt. At some pivotal moment, wealthy individuals just stop trading their limited hours for wages. They realize that, hey, there are only 24 hours in a day, and you can literally only work so many of them. So instead, they transition into owning assets. Assets that don't sleep, they don't take vacations, and they just continuously generate wealth in the background. And the most accessible asset out there? It's a stock. Now let's grow on this concept a bit. Imagine a small, incredibly popular pizza shop right in your neighborhood. It's packed every single night. The owner wants to open 10 more locations, but wow, that costs millions. Instead of taking out a massive bank loan with super heavy interest, the owner sells tiny pieces of ownership in the business to investors. If you buy one of those pieces, you are now a part owner. A stock isn't just some flickering number on a screen. It is a piece of a real breathing business with employees, customers, and actual revenue.
But that raises a really interesting question. If a business is so incredibly successful, why would the founders want to offer up ownership to absolute strangers? Why share all that wealth?
While the answer is actually pretty simple, growth costs serious money. Companies use investor capital to do huge things. We're talking building new factories, developing cutting-edge technology, hiring the absolute best and brightest minds, and expanding their reach internationally. By raising money through the stock market, the company gets the cash it needs to just explode in size. And if the company succeeds, both the business and its public shareholders reap the financial rewards. It is literally the ultimate win-win scenario.
So how exactly do you get richer from this whole setup? The mechanics are actually super straightforward. Step 1. The stock price is simply millions of investors constantly estimating what that business is worth today. Step 2. Let's say over 5 years, the company uses your money to double its profits and expand globally. Well, that brings us to step 3. Because the underlying business is literally producing twice as much, investors now believe it's worth far more. So that $100 share you bought, other people are now willing to pay $200 for it. You didn't get richer by magic, you got richer because the business you own became more valuable.
But wait, there's a second way you make money here, and it's a massive favorite for long-term wealth builders: dividends. Some highly profitable companies choose not to keep every single dollar they earn. Instead, they distribute a portion of those profits as straight cash payments directly to you, the shareholder. Imagine owning 1,000 shares of a company that pays just $1 per share every year. You receive $1,000 simply for being an owner without ever having to sell a single share. That right there is your money working for you.
Which of course brings us to the elephant in the room. If this system is so powerful, so incredibly tested, and so straightforward, why isn't everyone rich? The central thesis here is absolutely fascinating. The actual mechanics of investing, buying a piece of a business and letting it grow, are incredibly simple, but the act of staying invested, that is incredibly difficult.
The honest truth is, human emotions are our own worst enemy when it comes to wealth. We get trapped in this really destructive pendulum between greed and fear. On one side, when prices skyrocket, greed just totally takes over. People rush to buy in out of FOMO, the fear of missing out, usually right at the absolute peak. And then on the flip side, when prices inevitably dip, fear takes over. Beginner investors panic and sell, permanently locking in their financial losses, right before the market even has a chance to recover.
You really have to internalize this core truth. The stock market is not designed for adrenaline junkies. It rewards patience far, far more than excitement. Think about it like planting an oak tree in your backyard. If you go out there every single week, dig it up and check to see if the roots are growing, you are going to kill the tree. It literally never has a chance to develop. Investing works the exact same way. Leave it alone and let it grow.
And when you do leave it alone, you unlock sheer mathematical magic. Albert Einstein is often credited with calling compound interest the eighth wonder of the world. Now, whether he actually said those exact words or not, the principle is absolute reality. Your time is ultimately the single most valuable asset you possess as an investor. Let's look at a really concrete example of this. Just $200. Imagine investing this seemingly small amount every single month. In the first year, your money earns a return. But here is where the magic actually happens. The next year, those returns begin earning their own returns. And then those returns earn even more returns. Over 20 or 30 years, this creates a massive, unstoppable snowball effect of wealth.
And that snowball effect is exactly why time beats timing every single time. It's really not about how much you invest initially, it's about how long you allow that investment to grow. This is why someone who starts investing in their 20s often ends up with significantly more wealth than someone who starts in their 40s, even if that older investor contributes way more money every month. Basically, time does all the heavy lifting for you.
Understanding this time horizon really helps dismantle the biggest myth out there, the idea that the stock market is just some giant casino. Consider the mindset difference here. A gambler is basically just throwing money at a table, hoping magical odds work in their favor just for a quick thrill. An investor? Well, an investor studies real businesses, understands risks, diversifies their portfolio, and focuses entirely on long-term value. Investing isn't a game of chance, guys. It's a calculated strategy of ownership.
And a huge part of that calculated strategy is, for sure, diversification. Experienced investors never, ever bet everything on one single stock. Instead, they spread their money across dozens, sometimes hundreds, of companies in totally different industries. They accept that yes, some individual companies will fail, and yes, economic recessions will happen. But by spreading their money out, they drastically reduce their risk while still capturing the long-term upward trajectory of the broader market.
When professionals actually do evaluate a single company, they aren't chasing some viral trend or, listening to a flashy social media influencer promising overnight riches. Instead, they ask incredibly simple, grounded questions. Is this a strong company? Does it make consistent profits? Can it continue growing for many years to come? If the answer is yes, then a temporary drop in its stock price isn't a reason to panic. It's a massive opportunity to buy a great business on sale.
The barriers to entry are pretty much gone. Today, with modern platforms, opening an account is so easy. You can begin right now with whatever you have. The true challenge, the genuinely hardest part of all of this, is developing the relentless patience and discipline to stay invested when the news headlines get scary and the markets are jumping all over the place.
So, the absolutely crucial point here is this. The stock market didn't create wealth only for the rich. It is the very tool that helped ordinary people become wealthy in the first place. You don't need to be the smartest person in the room, you just need to be the most consistent. You need to deeply understand that you are buying ownership, you have to control your emotional pendulum, and most importantly, you need to give your assets time to grow.
Which leaves us with this final, vital question to close out our explainer today. I want you to take a really hard look at your own financial life. The richest people don't simply work for money. They own assets that work for them every single day. So ask yourself, is your money working for you today? And if not, what is one small step you can take right now to change that? Thanks for joining me on this explainer. Stay focused and start building your future.